gold is approaching a major liquidity zone right now, and smart money is actively preparing the next aggressive move. My primary focus today is a strongly bearish setup targeting the sell-side liquidity pool precisely at $3,973.15. We are not guessing here. We are tracking institutional footprints. Let's break down exactly how to capitalize on this upcoming displacement. We're anticipating a short entry to ride a macro structural drop directly above key retail liquidity. But here's the problem. There is one critical condition that absolutely must happen first before a single execution is placed. The market is flashing a warning signal right now, and if you act prematurely, you will find yourself on the wrong side of the algorithm. Look at the macro environment on the H4 chart. The dominant institutional order flow is undeniably bearish. Sellers are in complete control. We've seen an aggressive downward expansion that just sliced right through the psychological $4,000 level without a single structural sign of reversal. Right now, most retail traders are looking at old support levels as buying opportunities. That's a fatal mistake. Institutions are utilizing these intraday pullbacks simply to distribute more short positions. Because ultimately, institutions are drawing price down to a much deeper objective. Our final major macro daily liquidity target is resting all the way down at $3,955.00. This is the overarching objective the algorithms are programmed to seek, and it completely dictates our higher time frame bias. Every minor rally you see today is just a stepping stone to fuel the drive down into that $3,955 external liquidity pool. So the crucial point is knowing exactly where to do business. We have to contrast the premium array, where we actually want to enter, with the deep discount target zone. We are looking to position ourselves short strictly inside the premium pullback zone, specifically between 3,990 and 3,995. The discount levels below 3,973 represent the target zone, where institutions are aggressively drawing price to sweep stops. Simply put, you sell in premium and you take profit in discount. Shifting our focus to the macro evidence on the daily chart, the market bias is heavily bearish. We have a sustained long-term trend of consecutive lower highs and lower lows. Higher timeframe premium arrays are continually being respected, while discount arrays are just being completely run through. This is classic institutional distribution. Smart money is aggressively breaking key daily levels, leaving massive sell-side liquidity exposed. Drilling down into the H1 timeframe, the internal structure becomes crystal clear. Price delivered a decisive break of structure to the downside, fracturing that previous low near $3,990. That old support was shattered with massive displacement, transforming it into a high probability bearish breaker block. And resting right inside that block is an unmitigated fair value gap. That is our premium resistance sitting just above the current price. But what actually drives the market into these algorithmic levels? It comes down to macro catalysts. Right now, Federal Reserve Vice Chair Jefferson is facing a profound policy dilemma. Energy shocks and AI-driven supply and demand shifts are colliding, raising fears of embedded inflation. Meanwhile, escalating geopolitical conflicts in the Middle East and strikes on WTI crude oil transit lines are maintaining high inflationary pressure. This macro friction provides the necessary volatility fuel for the algorithms to expand. And this volatility isn't random, it's scheduled. During the mid to late New York session, we have a cluster of high-impact US dollar news events: building permits, industrial production, and consumer sentiment. Algorithms use these specific time windows as a volatility injection. That news is the exact catalyst the market makers will use to rapidly sweep engineered retail resistance and drive price down into our lower timeframe targets. Let's break down the exact executable steps to enter this trade. Listen carefully. Right now, no valid institutional confirmation has appeared. There is absolutely no trade to be taken at this current moment. Institutional discipline requires waiting for the specific sequence to unfold. We are targeting a short, but we are waiting for the algorithm to reveal its hand. To actually execute this, the M15 chart must deliver a specific sequence. We need to see price trade up into our premium zone at $3,990. Once there, we require a market structure shift. We need a strong bearish displacement candle that violently breaks a minor swing low inside that premium zone. That displacement is your institutional footprint. It confirms the algorithmic shift from buy-side liquidity engineering back into sell-side delivery. Without that M15 shift, we sit on our hands. If that confirmation triggers, here are the strict institutional trade parameters. The entry zone is between 3,990 and 3,995. The stop loss goes precisely at $4,002.50, tucked safely above the bearish breaker zone. We'll scale out partially at our first take profit of $3,975. The secondary target is $3,965, and our final runner targets the macro daily liquidity at $3,955. This provides an exceptional 1 to 3.5 risk-to-reward ratio on an 85% probability setup. Now this brings up a critical question. Where is most retail money about to make a fatal mistake in today's session? While we wait patiently for premium, the majority of uninformed traders are reacting emotionally to the current chart. This is the scenario most traders are completely ignoring, and it's exactly where smart money intends to capitalize on their impatience. Right now, retail is panicking. They see the heavy bearish momentum and are aggressively selling deep in the discount zone around 3,979. Selling here means selling the absolute low of the dealing range. This carries incredibly poor risk to reward and positions them as the perfect liquidity targets. They are effectively handing their money over to the algorithms. Here is how the smart money trap will likely unfold. Institutions will engineer a slow, corrective spike upwards into the London and early New York sessions. This intentional move seeks premium pricing and systematically clears out all those early retail shorts. Once that buy-side liquidity is swept and retail is stopped out, the real algorithmic expansion downward begins. We must always define our risk. The absolute invalidation level for this entire bearish narrative rests at $4,015.00. If we see a decisive hourly candle close above this level, it destroys the bearish order flow narrative entirely. It would signal a macro shift to the upside and our short setup would be completely canceled. We only trade when the probabilities remain heavily skewed in our favor. Your immediate action plan for today is simple. Wait. Institutional discipline means sitting on your hands and letting the market come to you. Do not chase price in a discount. Wait patiently for the New York kill zone to draw price up into the premium fair value gap, and do not execute until that M15 shift confirms the entry. The highest probability trades require absolute patience. If you value institutional-style market analysis using smart money concepts, consider subscribing to ICT Market Theory. And if you'd like to trade these exact algorithmic setups with institutional-grade execution, you can find the FXTM broker account link in the pinned comment below. Remember, the market pays those who wait for their setups. Stay disciplined, wait for the kill zone, and ask yourself, are you providing liquidity today, or are you hunting it?